with Kelly Wilson of the Wilson team, and today we have a very special guest, one that I've been waiting a long time to talk to. It's Colin Ketty from Synergy Family Office, and he's also a published author or columnist, right, that does a lot of writing around planning and taxes. And we're really excited because this article that was just published not too long ago, the biggest problem you don't even know you have. And I absolutely love that title, but it's part of what we know as, you know, the common theme about people's actual planning and what retirement looks like. So we don't want to just teach people how to go out, buy real estate, or what kind of returns they can get on whatever investments that they have.
Right.
There has to be an outcome, right?
Sure.
And when we're finding that, you know, when you're looking at the scary stats about the largest segment that is retiring in the next little while, and Canadians are anywhere from $500 to $1,000 short, and that's just to maintain living expenses, right?
Sure.
That doesn't even talk about any additional costs that may come
Absolutely.
through. So we wanted to bring you in here today because you do have the mindset of real estate where a lot of planners don't really take that into consideration other than just an asset. Right?
Yeah.
But you're somebody that personally believes in real estate as part of that planning.
Right.
And we want to look at some of the biggest mistakes that people are making in that plan and not being aligned properly, right?
Right.
And one thing I do like about your strategy is you say, you know, not enough people talk to each other.
Yeah.
Right? You've got your planner, your accountant, the most important people that
Yeah.
are in your circle, and not one person has a conversation.
Yep, they're very unconnected. It's very rare that the accountant knows the lawyer or the financial planner knows the insurance individual. So we really try to either bring those people together or bring the information together on behalf of the client.
Yeah, and I do like that's sort of your Synergy Family Office, right? The
Right.
whole concept of
That's what family office is. It's bringing that information together and the people together.
So let's talk a little bit about why you got into planning to begin with.
Sure. I got into the financial industry almost a quarter century ago. Pretty typical, humble beginnings, working in the family or the family market, dealing with the typical mom and pop. Around the time of the tech boom, so returns were fantastic when I started out in the business. But if you remember the tech bubble, it completely exploded and things really fell apart. And so I quickly realized that, you know, there are some really uncontrollable things in this space that I cannot manage. And certainly what happens in the marketplace would be the biggest one. So what I did is I set out to look for something that I could utilize, like financial planning, and, you know, where it's not related to the market, it's more focused on taxation and how things work and what the benefits are for people. And it's interesting because in the financial services industry, we're always taught as to how to accumulate money, but there's very little effort put into how to get that money back into people's pockets. Mm-hmm. And as you can appreciate from the institution's perspective, you know, the money is made on the accumulation, not on the exit of that money. And so what financial planning has done for me is it's allowed me to strategize with clients as to what the most effective way to get that money back into their pocket, you know, and you know, enhance cash flow, minimize taxation. So, you know, that's what I've been doing for the last, you know, nearly 25 years, as I said, you know, and the financial planning side of it and using the planning analytics is, you know, a huge part of my business. I couldn't imagine not doing it.
Yeah, so when you're looking at, you touched on something, you said about the investments, right? Of actually the earnings all the way through. And I know a lot of people say, okay, we need to put a little bit in RSP, we need to put a little bit in tax-free savings. But
Sure.
What is sort of the difference between somebody going out to say, you know, I've got this, I've got my investments, I know where I'm going, versus an actual financial plan when you're sitting with a professional and looking at that and the objectives that, you know, what's entailed with that?
Well, first and foremost, I think the major misconception that I see with people that come into my office and we have this conversation around, do you have a financial plan? Which I like to start as my very first question. Do you have a financial plan? What does it look like? And typically what I'm seeing is people are coming in, they're bringing statements. Mm-hmm. To which my response would be, that is not a financial plan. Those are your investment statements. You know, the financial plan is the guideline that again explains, you know, how will you accumulate that money and how will you distribute that money over time. And so I think that's probably the single greatest issue is that, you know, although people have the assets, and you certainly need that to fuel your financial plan, there is no real underlying plan itself.
Mm-hmm. And we do see people, you know, and being in the mortgage industry, people are coming in, they're very concerned about what rate they're paying on their mortgage. The reality is when they're coming in, it doesn't matter, you know, 9 months ago it was 1% higher. People are still buying properties, right?
Yeah.
And you look at somebody who said, oh, I just want return. How much can you make me? The reality is people have no idea what they paid in taxes last year.
Yeah.
Right? How many people know their exact tax rate of what they paid?
Sure. And so, and again, as we, you know, I mean, in the early stages of what I'm doing with clients is really just asking questions, trying to get a sense of where they are. You know, you commented to the article there, you know, the biggest problem that people don't know that they have. So we sit down and you know, have that discussion, you know, what's concerning you, what's keeping you up at night. And, you know, unfortunately, you do hear a lot of, I don't think I'm making enough return, or, you know, I am concerned about market volatility. Mm-hmm. No question, those things are very real. But for the high net worth client that I'm dealing with, really all clients, you know, what they seem to negate or is that probably the single greatest problem that they have is that tax liability. And so, you know, when I'm talking to clients about, you know, what does that mean? You know, one of the things I will ask is say, okay, well, if you could receive a 10% rate of return, would you be happy with that? Yes, that would be great. Okay, well, let's, you know, obviously you're going to have to take a certain level of risk to achieve that. Now let's look at this a very different way. What if you could reduce your income tax and say maybe only get a 5% rate of return, and let's assume that the risk associated to getting a 5% rate of return was much lower. So if we could combine the reduction of income tax and that lower rate of return, still achieving a rate of or sort of an assumed rate close to the 10% rate, wouldn't that, as long as you're getting the same result with less risk, wouldn't you be better off in doing that? And again, that's that tax part of that question. So, you know, in Canada, the highest paid tax, you got 53%. You know, what could that mean to your financial situation if you could reduce your tax by 10, 15, maybe even 20%? And maybe in some scenarios, you could have income where there's no tax at all. Mm-hmm. And I think, unfortunately, that's it. So many Canadians are taking risk, you know, they're chasing that return, which means they're subject to volatility, when really where they got to be focused is on the tax treatment first and foremost. For us, that's the center of everything we do. We look at tax and we work our way out from there.
Mm-hmm. And what I do like about your thought process is, again, you do see real estate, right, as a very important asset to have in that plan.
Absolutely.
So maybe you can talk a little bit about why you like real estate so much in your plan.
Yeah, so, well, and actually kind of a funny story. So before I started my practice on my own, I was working for a very large institution. We had 36 offices across Canada. And so my role was I was kind of the planner's planner. So you as the stockbroker would call me up. I'd come into your office and I would do this planning analytics. I'd work through the financial software with the stockbroker and with the client. And you know, often you would have clients who would turn around and say, you know, how do you feel about this type of investment, or what do you think about that? And the reality is, for me, I've always been more of a real estate person. So as we're having this conversation, my answer to that person is, well, you know what? Very little of my portfolio is actually made up of the stock and bond. I'm a real estate guy. As we sit here in this office building, I own it, and so I absolutely I am very. You know, it's not the only thing, but it is huge. You know, when I get in conversations about real estate with people, I think most people don't realize that more people have become millionaires through real estate than they ever have through the stock market. Mm-hmm. So, you know, where do I see that value? And again, I'll go back to the planning, I'll go back to the tax aspects of it. Real estate's capital gains. So from a tax perspective, that's about as good as it gets. Mm-hmm. Now I can acquire this massive asset, but I don't have to put the total amount down. Imagine if you want to buy $1 million stock portfolio, your broker doesn't, well, I mean, you can leverage, but rarely are you putting a fraction of that down to get control of that entire asset. The other thing I think that's important with real estate is you own it and you control it. So, there's no issue of whether there's a scandal or anything else or market conditions and volatility. People need property. It's always going to be a necessity. And so it's very tangible, as I say. I mean, it doesn't have a correlation to the market. It's got fantastic tax treatment. I need very little money down to own that asset. So again, it's balance. It's really just part of it. It's not everything, but it's certainly it's a massive part of what we do. And we do encourage our clients, in the family office model, because we are not stock, bond, investor brokers. We're really looking at that large picture, and I would say probably 90% of my clientele personally owns real estate directly.
Right, and you're looking at just natural appreciation. You're
Absolutely,
looking at the tenant being able to cover off that payment for you. So it's not your net dollars,
Right.
It's somebody else's net dollars, right? And then you talked a little bit about the capital gains aspect. Obviously, one of the most favorable taxes out there, right? So talk a little bit about capital gains in terms of once you hit retirement. How do you see people using it? Are they cashing it out? Are they just re-leveraging? What does that look? Do you have any sort of...
Well, yes. So from a cash flow standpoint, no question. I mean, capital gains are huge. So, and again, if you are building, the real estate into your portfolio, certainly an option could be that you could leverage back out the underlying asset, the cash that's built up in your property. And if you're lending it back to yourself from an income standpoint, that's a loan. That loan doesn't necessarily have any income tax attributed to it. So if you've got that property and you haven't sold it off and you re-leverage it back, sure, you're going to have interest on that loan, but chances are that interest is not 53%, so it's going to be far less than what it would be, if that was your typical interest bearing or earned income. Like I say, it could be high as 53%.
And so what is your stance? I know there's a lot of conversation that goes around RSPs. How do you like to talk about our RSPs when your clients are coming in? Because you see some people, that's all they have, right? When they're coming in, and then you've got other people that aren't maxing out. So what's your stance on, and I mean, some planners are very RSP centric, right?
Yeah.
So what's your stance?
Well, again, I think it's about balance. Typically, what I say to clients when we're looking at RSPs, I say RSP is kind of like this cup, okay? I mean, I can pour the coffee into the cup, and once it's full to here, it's served its purpose. If I just keep pouring, that coffee's coming out of the cup onto the floor. Think about that portion as your taxes, okay? And so if I use it again in balance, it's part of it. It's not everything. I do believe in it. Yes, there is the tax benefit, but again, looking into the future, and that's what we can do with the plan analysis, is saying, how much income is that creating in the future? So as you say, where you've got people who are very RSP centric and everything is focused towards that one area, then rest assured, if not say at 60, 65, by the time that you're 71 and you're forced to RIF, you've got your RIF income, you've got your CPP, you've got your OAS. You probably stand the chance of losing that OAS because you're taxed at the highest rate on all of these things, and maybe there's a pension mixed into that. So although RSPs are good, as they say, you don't want to have too much of a good thing.
Right, and I think it's not that it's good or bad, it's about how much do you need in that plan?
Sure.
Because it could offset something else that you should be entitled to, right? You could be losing things on the other side. In
respect to what you were saying about, and what about TFSAs? Well, TFSA was brought out in 2009, and I think for a lot of people, and especially I see this in the higher net wealth community, or really with anybody, what am I going to do with a $5,000 investment? That was kind of the thinking back in 2009. But, let's fast forward a decade. It's not unrealistic that the average household might be sitting now on, well over $100,000 of whether they've actually made the contribution or not. And, I find it hard to believe that so many TFSAs are completely unfunded. but they
That's
are.
unbelievable.
It's unbelievable.
Yeah.
But I think again, goes back to that conversation you're saying about RSP and TFSAs. A lot of people, well, in my RSP I get a tax break. Sure, it's got this initial instant gratification, but again, you got to look at it in the model. What's it look like over a long period of time? But my point being now is it is coming more. It is coming more into the spotlight. Where people are looking and saying, "Hey, this is a significant amount of money, that I can put cash, and again generate tax-free returns." And if they are looking at all sources of income, hey, if I could receive, $500, $1,000 a month, even from that tax-free account, that's pretty significant because cash flow is king, right? And that's the most important. So we're even seeing where we're actually melting down the RSP and putting a greater focus into the TFSA side of things. And that's a strategy we've been working on for over the last half decade, putting more of a focus onto the TFSA side of things. And so again, from a planning standpoint, we can put the stuff on the model and say, even if someone's on a budget, hey, all I have is $10,000, then maybe what you do is it's $5,000 of RSP and it's $5,000 of TFSA, trying to find that balance again with a tax focus.
So what are some of the misconceptions that people have in planning, right? So they hear, yeah, I should go see somebody, I've got this, but what is a lot of misconceptions that happens in, an actual financial plan?
Well, again, we're kind of going back to the things you mentioned, like real estate. So if you are doing a true financial plan, again, it's not your investments. Those are products. That's not a plan. What you need to do, that financial plan, the misconception is that it's very focused on what you might be doing, say in the stock market, whether that's mutual fund or stock and bond. The financial plan should capture all of these things. So your pension should be listed on there. Yes, your RSPs, your TFSA, stock, bond, that sort of thing, non-registered. If you're self-employed, or you maybe you're retired with a holding company, all of those things need to be captured on there. And the focus of what comes out of that should be tax centric. So the misconception is, that people are looking specific to that area, and you need to have all these things. And it should be something that's written out and showing from now until, whatever your life expectancy is. So I would say the biggest misconception is just how focused it is on the market versus your overall financial situation.
Yeah, and I think that when we talk about you say you have a group of people that like to speak to each other, right? What are the main conversations you're having with the accountant?
Yeah, fair. Yeah. So and just to kind of set that up, when someone comes into my office, one of the things and again, just to sort of check their pulse on, where their situation and circumstances are, as I say, I'll ask them if they have a financial plan, and regardless of how wealthy they are, I'll tell you that it's a real rarity. Even client $10-30 million that they've actually done this. We're all focused on our businesses, and that's that's the main area that we're focused on, so very little is done on the planning side. Then I get into the discussion, what's the relationship of all of these people? And so, you've been to my office, I've got my board table there. So as the client sits there, I'm saying, if your accountant, your lawyer, your financial planner, your insurance guy, your 3 investment advisors, and you could have 3 because you probably don't trust one of them. What is that relationship, as you say, and are these advisors communicating? The reality is all of these people are working in isolation of their own skill set. And so there's nothing wrong with that. But chances are, if the insurance person was talking to the investment advisor is talking to the accountant, and if we could bring that all into one central area, which, and I guess I'm biased because that's what planning does, if we could get these people communicating, this is where, good conversation happens. And we can better determine, I didn't consider that. That's not my field. And okay, now that you explain that to me, okay, I think we can make a better decision for that client, for their finances.
Yeah, absolutely. And like you said, It doesn't matter. When I'm looking at my T1 generals at the end of the year, I mean, I'm being self-employed, you're self-employed, and we don't have the benefits of pensions, right? So we really have to work hard to be able to create that system, that blueprint, right? That allows us to get into that. And really, I think what scares me the most is there's not a lot of room for error, which is going to lead me into my next question. I know people hear about insurance all the time, and I have a lot of it. And I know you have a lot of it, but there's a lot of different ways that people can use insurance, and I do really want to touch a little bit about that because some people are using it as just a pure asset class, right? Yeah. And you've got a really neat system of what you're doing with a lot of the wealthy clients, and that is more of a tax planning, right, product. And then you've got people who are trying to protect credit. Right, and then you've got other people that are trying to leave generational wealth. Right. So maybe you can talk a little bit about how insurance plays into your business.
Yeah, well, I think for most people, the very typical understanding of insurance, and this is and always will be, is that insurance is there to cover liability, replace income. If you're a family, and especially a young family, you're earning an income and that person is gone, you want to be able to replace that income for those years. And so I think most people can get their head wrapped around that concept of insurance. And where that changes when you start looking, as you say, using insurance as an asset class, say with a wealthy individual who's not considered insurance as an asset, or you get to that point in time, you're like, hey, I have $1 million, $3 million, $5 million. I'm self-insured. I don't need that asset anymore. I don't need that insurance anymore. Well, not for the reasons that you're thinking in respect to replacing income, but yes, from a tax strategy or planning standpoint. You had made a comment earlier saying, there's very little room for error, and commenting about, with retired individuals, they're coming up short. And so the greatest concern for most people is, that am I going to spend through all of my assets? So if you're coming up short, then chances are you're not pulling enough out. So how do you deal with the coming up short? You start spending more money. Well, if you start spending more money, obviously you're encroaching upon your capital. The concern is, do you have more life than you do capital? Right. So if you outlive that money, then you've run out. So from insurance as an asset standpoint, what we're seeing is people will have insurance that will last their lifetime, so that as they spend down through the assets, and they are encroaching upon capital, and interestingly enough, in doing that, there's some real tax benefits in doing that they maybe get to that later stage of life. I mean, that could be 75, 80, 85, where they've spent most of their assets. Maybe they have rental properties, but now they have this insurance policy that was paid for years and years ago, to which they could go to the bank and say, hey, this is bought and paid for, okay? We're all going to die. Let's say it's worth $1 million and I'm 85 years old. I've run out of money, and sometimes people do. Can I use this insurance for my purposes? Which, and that's sort of the paradigm shift for a lot of people is, when I talk to people about insurance, it's, well, that's not for me, it's for my beneficiary. Well, think about that insurance policy as you might, whether it's your own home or it's rental property. It is an asset, okay? It's going to pay out one day. So if you could take that asset, the same as you would say with the property that you might remortgage again, and so could that create, future income or cash flow, when you run out of these other assets? And again, insurance, unlike your stocks, your bond, and even like your real estate, it is completely uncorrelated to those things. So again, we talk, people talk about diversity. Do you truly have diversity? A lot of times, we've had this discussion before where the diversity is all in the stock market. Well, it's not really diverse if it's all in the stock market, 100%. Because they're all headed in one direction. Sometimes good, sometimes not so good. So insurance provides that, and insurance is great in the sense that it's very risk averse, and a lot of people don't know that in permanent insurance, this insurance we talk about that you can have throughout a lifetime, and risk typically the term used with risk is standard deviation. So that is the the up and the down. What level of fluctuation does that investment have to achieve a return? So in the case of the market, it might have a standard deviation of 12 or 14% to only receive a return of 7. So that's a huge standard deviation for what the return is. In the case of insurance, the standard deviation is actually lower than a GIC. But you've got the math.
Right.
And again, that's the purpose of putting something on a model. What is a financial plan? Well, in behind it, it's simply Excel. It's mathematics. And certainly one thing I can say, nearly 25 years of being in this business, you see all kinds of trends, things come and go. But I can tell you that since I started, 2 + 2 still equals 4.
Yeah.
So when you look at these things and you start running the models on them, or sort of running the math, if you will, that's where this stuff all susses itself out. When you start looking at this, but for most people, it's like, well, this is what everybody's doing, or everybody's doing this, or everybody's doing that. Well, the reality is, all the wealth is held by one person. 1% of people. So do you want to be the 1%, or do you want to be everybody else? I think for a lot of people, they'd like to be the 1% of the population with all the money, not necessarily doing what everybody else is doing.
Right, and the people that are the 1% are the people that are taking the time, concern, and care to find the experts to put the plan in motion.
Yeah.
Right? It's not just like, hey, I'm going to run to the bank and I'm going to throw my money in here and just hope I get my 3% or I don't lose 30 in the recession, right?
Sure. And what's interesting, people will ask me, well, why does this sometimes not work? What are the stumbling blocks that you run into? Probably the biggest stumbling blocks is, number one, people don't want to upset their current advisor. Well, do I have to, I've got to get rid of my advisor and make a change? Well, sometimes, yes, that is the answer. But, are you doing this for him, or are you doing this for you? And the other side of that is, we see a lot of is, like, I sit down and I walk people through the financial plan and say, here's all the this seems like it's a lot of work. And it is a lot of work.
You can't afford not to do it.
Right. And it's like, some people will say, well, can my financial plan not just simply fit on one piece of paper? I don't know. Does your life story fit on one piece of paper? And it generally doesn't. So that is the reality. It takes time to capture that information. And what we say to our clients is, listen, we're not meeting you in the middle. You provide the homework, whether that takes an hour or 2 hours, we're going to spend 10, 20 hours doing, the analytics to do these calculations. But it is a team sport. This is not, I'm going to drop my stuff off. Knowledge is power. Like, we want our clients to be educated, because we want to be able to communicate this back to them. And it's interesting, because what I find is the more wealth they have, the more time they're willing to put into it.
Interesting.
So we have clients, $10 million, and we're speaking to them monthly, in some cases bi-monthly. And I know a lot of people would make the assumption, well, it needs more. It really doesn't need more. It's that they have a greater concern. I mean, think about it. What's the difference between $1 million and 10 million?
Right.
Just 1 0.
Yeah.
But the reality is they're probably making a lot of decisions, or could be making a lot of the same decisions as that guy with $1 million. The difference is that they are concerned. And I can tell you, it's amazing how many people are like, oh, that just seems like a lot of work. And what I've certainly come to realize, the more money that people have, the more care and concern that they're willing to put into it, which I guess is why we can say, why do the rich get richer? Because they work on it. They put the time into it. And for a lot of people, unfortunately, like I say, whether it's upsetting, the other advisor, or it's the work that has to go into it, and you can't please everybody, and it's going to take some work on the part of the investor.
Right, and you think about what everybody's doing, and they're going to work 40, 50, 70-hour work weeks, killing themselves, right?
Yeah.
To pay the bills, and then to put whatever net dollars is left. Why are people not paying attention to what is going on, and so is it a lack of information out there?
Well, you could probably have a whole podcast on financial literacy. I mean, you've all heard the discussion of like, why don't we teach this stuff in school?
Right.
And it's just not.
Right.
And so, but so again, you can go way down the rabbit hole on that. It's a huge issue.
Mm-hmm. And if somebody is out looking for somebody to work with, what do you think are some really good questions to ask that person, right? When they're doing an interview, if they want to go seek somebody for the first time?
Yeah, and that's a great question. And when I meet people for the first time, I tend to find they sometimes seem, I don't know if perplexed is the way to put it, but I say to them, go out and get multiple recommendations, like see what's out there. And one thing I almost always say to people is, if I never see you again, here's my one piece of leaving advice. When someone says you should do this, whatever this is should be verifiable. So you commented earlier on, hey, we should do, RSP, that's the greatest thing. Load everything in there. That's your primary focus. Start with that. If that's all you have, put everything into the RSP. And so I'm not saying it's not, and I can certainly tell you I've never seen two identical financial plans, but there are some principles that tend to repeat themselves. But if someone says this is what you should do, and I say here's my piece of advice, based on what? How did you come to that conclusion that that's what's in my best interest? Because again, we talk about things like in retirement, losing your OAS. Was that because you compressed this, sure, you get a tax benefit putting it in, but are you compressing for a bigger tax liability down the road? Have you actually looked at this to say, this is why it's the best? Like your board shows there, you're not writing a number at the bottom. No. You've added, you've subtracted, you've considered expenses and everything else. The information is there to make, to make a decision about why it's best. So if you are doing financial planning, and again, there's all kinds of different software out there and everything else, but you should have a baseline. Here's what I'm doing now. Here's a decision, and in making the decision, some sort of result should come, which is a benefit, whether that's reducing tax or it's increasing income. And I don't mean by rate of return. If someone says, hey, you're earning 5%, and if you earn 7%, you'd have more. Well, I think that's pretty straightforward. That's very obvious. So it's more about those structural differences. And so if you were doing things like that, and again, for us, we really feel that it's very tax-based. You should be able to come to some professional. More often than not, it tends to be an accountant, sometimes a lawyer, sometimes both, and say, can we verify this? Here's what my financial planner is saying. Certainly, if your financial planner said you shouldn't share the information with anybody, I would be concerned about that answer.
And how much do you look at the physical budget? I know people have a certain amount. They might come to you and say, listen, I've got an extra few $1,000s a month. This is what I want to do with it. Is that somebody you're going to want to work with? Or do you try to find different ways of slimming or changing what their current amount is? I mean, I'll give you an example. We have, some people do have a situation where they get into some debt because maybe they've had a job loss. And they were high income earners, right? And there's this stop or change, or maybe a spouse got sick and they've had to take time, and there's this interruption, right, in their whole planning. And we've been able to recapture a lot of maybe paying back off that debt and then reducing their overall monthly costs substantially, so that they could rework that number back into the whole investment side or portion of it. And I know that a lot of people don't ask about the mortgage, and we're trying to teach a mortgage as a tool, right? Can you get away with an interest only? Why does that make sense today based on the current rates?
Well, I think it's that perception that debt is bad, and you want to get away from debt. And again, when doing planning, one thing I would say to anybody, there's only one thing we can count on here. And that's change. And so whether that's a loss of a job, it's, a spouse dies, it could be good things. Hey, my income has doubled. The reality is that some sort of circumstance is going to change. whatever you're doing from a planning standpoint, it needs to be organic. So when you ask the question about budget and, how do I look at budget? Well, I look at budget like this. If you needed $100,000 of income, and it looks like you've met 100% of your goal, and there was an opportunity that you could increase that income to $130,000 a year, we want to look at stretching the opportunity, not that you're necessarily spending it, but we want to make sure that cash flow, is the best that it possibly can be. Because if you run into a circumstance, and, people talk a lot about this, is the disability aspect. The person's not dead, they're still alive, and now what are all the expenses related to that? That's kind of a catastrophic situation, but what about hyperinflation? What about all of these different things? So you want to make that the best that it possibly can be. And you ask the question, hey, I've got this extra money and I want to do this. Okay, based on what? What will doing that versus this versus something else? Should it go into real estate, TFSA, RSP? So again, if you can create a baseline and say, I'm thinking this is what I want to do, then you should be able to measure that decision.
Right, and the fact that you've got so many different experts around you that have so many different opportunities, tax strategies, planning strategies, investment strategies, because you've made it, your whole passion is to learn as much as you can about what is not just inside the day-to-day box of what you can go into the bank and invest in, right? Or what you can go to somebody. So having that option is that, hey, I know a little bit about that, or I heard about that. You've surrounded yourself with an amazing group of people, right, through Canada, right, that have all of these different amazing strategies. But again, that's what the wealthy are doing. And why aren't people modeling what high net wealth clients are doing?
Exactly. And I sometimes when I'm sitting down with clients, I say, we have this very sophisticated strategy. We look at what wealthy people are doing and we do that.
Right.
and sometimes, and I just sort of say it to make a point. And I'm really not trying to oversimplify, but I do that to kind of shock them, because the reality, that's what it is. I mean, we're not trying to reinvent the wheel. These things are done. There is nothing new under the sun. So, a lot of the things that we're sitting down and doing with people, although they're like, I've never heard of that. I didn't know you could do that.
Right.
Everybody's doing this. Again, back to my point. Do you want to be everybody?
Right.
Or do you want to be that 1%?
Right.
So again, it's going to take work and it's going to take effort. You got to put the time in and get the education. And, when you say surrounding yourself with people, I remember early in my career, the gentleman who hired me said, the last thing you want to have is 25 years of 1 year's experience. So I don't want to be repeating my skill set year and year again. So I'm constantly looking at, what are the opportunities? What are people doing differently? Right. And then going to my network, whether that's on the legal side and saying, okay, what do you think the legal aspects of this are? What do you think of the contract attached to this? Or on the accounting side, do you see this as something that, is offensive to CRA? Are there issues of GAR, the anti-avoidance rules? And so not only are we looking at these scenarios, we're doing everything that we need to do to back check them to make sure, okay, not only does it sound good, we know that it works and we know that it's a realistic strategy, because let's be realistic. I mean, there are all kinds of things that people will do, and then all of a sudden CRA doesn't agree.
Exactly.
And you want to know that in advance. And listen, there's still...
Because you can plan for that, right? For the next fiscal year that's coming up, and then how do we need to change or restructure yet again, right?
Yeah, well, that's why I say the planning is mathematical, the returns are hypothetical. Well, you can plan for a return next year, but hey, we talked about this before. We're 12 years of a bull market. Will it just continue to increase indefinitely? Probably not. So when you talk about things like, can you be recession proof? Okay, well, there's no perfect, I can avoid recession. But again, from a planning standpoint, since we can't control the market, if we're going to be diverse, we're going to have real estate, and we're going to, have these things are not tied into the market. And again, we're going to focus on, reducing income tax. That, if we run into these circumstances of, hey, here's what's happened. I've lost my job. Okay, well, great. So we've done our best we can to reduce income tax. We've not tied you specifically to one segment. So we've got that cash flow. You're in that place where, like I said, it's not, you're not going from 100,000 to 130,000 because you have to. You're doing it because the circumstances may choose that. You know, it's interesting when we're modeling retirement, someone will say to me, well, I actually had one guy, he said, I'm not going to retire until I'm 80.
Yes,
and I thought, and hey, we know what they say, you know, do what you love and you never work a day in your life.
Right.
But I said, well, what about when retirement chooses you? He's like, well, no, why would it choose me? I will choose retirement. I'm like, well, what if you physically can't do it? What if you're disabled? Things happen, you know, that's the reality is we don't get the opportunity to sit down and go, I'm going to write this plan once. And all the aspects of this plan will never change. I can certainly tell you that, you know, over my career, TFSA didn't exist, and then it existed. RIF date went from 71 to 69, back to 71. I mean, I've sat with clients who never paid $1, you know, were at the highest tax bracket, say was 43%. Now they're in retirement and their tax bracket has gone to 53%. Think about the pressure that taxation has put on that money and the importance of going, okay, like, let's make that cash flow the best it can be. And again, this is, and I don't want to say that people are lazy, but this is a thing of saying, you know what, your goals are important, but again, have you made the decisions where it's not just hitting the goal, it's the best that it can be? Because let's be realistic, we have no idea.
No, we don't.
I mean, you could be in your 50, 60, 70, and you have medical expenses that, you know, they're outrageous. You get a lot of people who are retiring at home. If you come, you have that assistance in the house, or you want to be at the country club retirement home. That could be $5,000, $6,000, $8,000, $10,000 a month. So yeah, you certainly want to make, like I say, make sure that you have more capital than you do life.
Right.
Because if your life extends past your capital, you're going to find yourself in a bit of a situation.
And having the choice and freedom, right? To not just be stuck in one area.
Yep.
And you know, it's being able to be a bit creative. And one thing that, you know, I have to drive home to people is take all the time you need. This is, you know, it's funny because it's the most pressure it has on any human or family. You know, we say money doesn't buy happiness, but if I can write a check and make the problem go away, what does that do? What does that look like, right? Yeah. And people spend the least amount of time focusing on it. Yeah. And it's the biggest issue we have, right?
Yeah. And I think for a lot of people, in fairness to the investor, and what I'm finding is people saying, listen, I put the time in, but I don't see the result. Yeah. I met with one guy, he said this was going to happen. I've moved over there. The market fluctuates. And the answer tends to be the same thing. Well, it could be a whole lot worse than it is. Yeah. And again, it's all tied back to product. Right. And not planning. And, they used to, what was the saying? People spend more time planning a vacation than they do their retirement plan. And I have a client who, I believe his comment to me was, well, when I plan the vacation, I know what's going to happen. I do this retirement thing and, what's the result? Yeah. And touche, fair enough. So again, that's why I say when what are the typical results? Okay, it's X amount of dollars. But again, verifying what that is. You should have some sort of cost benefits analysis, that shows that you've improved your situation, whether it's cash flow or estate or whatever's important to you.
Well, I thank you very much. Everything has been always interesting, and I learn so much every time I talk to you. And if you have any questions, you can certainly get in touch with our team, 613-266-3570. And hopefully, if we can redirect you to somebody on Colin's team, we'll be happy to do that as well.